with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come, trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, May 29th, 2026. Some shout outs to Will, Carl, Don, Jody, Jason, Cindy, Kevin, Cheryl. Big shout out to Peter tuning in this week. Thank you all for tuning in week and week out. We so appreciate it. And we're glad that we can bring a service to you and keep you up to speed with what's going on out there. Speaking of which, what is going on out there? Well, let's talk about it. Look, markets continue to press higher. Dow Jones up 0.9% this week. S&P 500 up 1.4%. The NASDAQ Composite up 2.3% this week. Big mover there. The Russell Small Cap Index up 1.7% this week. So all the major indices pressing higher. The Volatility Index down 8% this week. So again, showing some complacency, down at 15.3. So we're really getting down in this complacent area. That's kind of interesting. It's kind of a contrarian indicator sometimes, but something that I like to watch. Taking a look at long-term bonds as measured by the TLT, they actually were much more constructive this week, up 1.27%. Saw yields come down a little bit on the expectations that maybe something's coming together there with the U.S. and Iran. When you take a look at the different sectors out there, the big loser this week was energy, down 5.4%. And again, you can thank the U.S.-Iran news headlines as far as that's concerned. If there's a cooling in U.S.-Iran, then there should be a cooling in oil prices. We saw oil prices come down. We saw energy prices drift down with them. Now, you may recall we trimmed back all of our energy holdings probably about a month ago now. But I'll say this, I don't know that the energy trade is over just yet. Not to get off down a rabbit hole here, but Exxon's saying that there's a major disruption here in supply. And in a matter of weeks or so, we're going to really see some incredible supply constraints that could really drive prices higher. So I think the market is reacting to the headlines, or is looking really far ahead, because this has caused a disruption that's going to be with us for quite some time. It's not going to end with the Iran war. It's going to be with us for a while. And I don't think the market's necessarily pricing that correctly, or it's getting way ahead of itself. As far as the other sectors are concerned, this week, utilities were down about 2%. Staples down 2%. So your defensive areas, right? Utilities and consumer staples down this week. And the hot areas, technology, up 5.8% this week. Both semiconductors, your hardware, and your software. Software really getting on the action this week. I mean, you got ServiceNow, which we have in our models. It was up 21% this week. IBM, which we have in our income models, up 17% this week. So software really catching some interest here and pushing higher. CrowdStrike, which we actually trimmed it a little bit last week, was up another 10% this week. 10% in a week. These stocks are moving in a major way, driving up the technology sector for sure. And everything else was kind of up, between 0.5% to maybe 1 or 2%. So pretty good all the way around, except for the defensive areas of the market. Gold and silver, gold up 0.8% this week, and silver flat on the week. Didn't go anywhere this week. So what's moving markets? Well, look, it's the AI story. It just continues to be really robust. Okay, you're seeing some big things just continue to come out in regards to demand across the board in regards to artificial intelligence and the equipment needed to make that happen. And then I mentioned ServiceNow a moment ago. Software companies have gotten crushed this year, and we have been adding to them pretty substantially. We've added quite a bit to ServiceNow, for example. And my argument has been that not all software companies are going to be destroyed by artificial intelligence. Okay, there are going to be software companies that are going to use AI and really expand their business and become even more relevant in the marketplace Well, there's a big technology conference this week, and Bill McDermott from ServiceNow is presenting, and he's just like, he just laid it out there. These folks are positioning themselves to be the entity to help navigate this world of AI for corporate America, and the stock reflected that this week with a big push higher. Semiconductor chips continue to get some action there. We talked last week about the quantum announcement with money being poured into some quantum companies like IBM and Global Foundries. And those stocks pushed way, way higher this week. Global Foundries this week alone, after a big move last week, it was up big time too earlier. We'll talk about that here in just a moment. Bottom line is the whole artificial intelligence trade is driving the market. On top of that, you had some good headlines coming out from U.S. and Iran war. Whether or not they'll amount to anything is, your guess is as good as mine. We'll just have to see about that. I just have no idea whether that's going to, really come to fruition at this point in time or not, because on one hand, they're saying they got a deal pending on, and I look at the next headline and there's missiles being launched. So I don't know how it's going to shake out, but the positive headlines, the market's trying to sink its teeth into it for sure. I still think there's some issues here, as I mentioned, for longer term for oil, et cetera. And then I tell you, one thing that really surprised me this week is we had a nasty inflation number, 3.3% on the PCE. That is the number that the Fed watches the closest. They wanted to be at 2. It's at 3.3%. We talked a few weeks ago about these inflation numbers and how nasty they're looking, and the fact that it's not all energy driven. We're seeing inflation in other areas of the market. The market didn't give a hoot about that inflation number. And I think I know why. Last week, not this week, but last week, Kevin Warsh was sworn in as the next Fed chair, and he gave a speech. And he said something that I thought was pretty impactful for the market. I think the market heard it loud and clear. He referenced Alan Greenspan. Alan Greenspan was the Fed chair during the raging tech bubble in the 90s and that big expansion that we had when Clinton was president. And what he said was, he mentioned the fact that Alan Greenspan let the economy run hot. And he praised him for it. Make hay when the sun is shining, baby, right? Look, if things are great, make the money. And that's what he really referenced. And I think by drilling down on that and making that point, he's indicating to the market that he has absolutely no interest or inclination to raise interest rates unless things are really getting out of control, because he wants to let the economy run. He wants incomes to go up. He wants more jobs to be created. He wants more wealth in your pocket, et cetera, et cetera. But listen, that is a fine line to walk, folks, and you got to be careful, because another round of inflation would be nasty, nasty, nasty. Now, I will say that there's some technicals that indicate that maybe the bond market's looking a little bit more attractive. I saw some work this past week on Larry Williams. Larry Williams is maybe one of the greatest technicians on the planet. This guy's been in the business since like 1970s. And I talk to him every now and then. Actually, we had an email exchange a few months ago. I was a little concerned about a few things for this forecast for this year, and we were communicating. But anyway, he was on CNBC the other day talking about bonds and how attractive and constructive they're starting to look. He thinks bond values are going to continue to go up, which means rates would go down. So that would indicate that maybe inflation is not here to stay if that comes to fruition. So look, we don't have a crystal ball. We don't know which direction they're going to go for sure. What we do know is we want to keep everything spread out and have some exposure in that space. And we added some money to bonds this week. As a matter of fact, guess what we did this week? I'll give you one big guess as to what we did this week. Yeah, you guessed it. We trimmed. We just keep on trimming. That's exactly what we did this week. We actually sold one entire position. We sold Global Foundries. I love the company. I think it's a great business. They build semiconductor chips right here in the United States. We bought it last May for $32 and change, $32 and change. And the reason why I bought it, we're going through the tariff tantrum, right? The markets are getting hammered. And what I liked about Global Foundries is it was a US-based chip making company. And the Trump administration's been very concerned about all of our chips being made overseas. They consider it a national security risk. I can understand their thinking. The thing is, Global Foundries mainly does chips for the Internet of Things, right? So chips in your TV, your refrigerator, your oven, things like this. They're not really doing high-end AI chips, but they are working on some quantum things. Anyway, make a long story short, the stock's been doing very well. And then this quantum announcement was made last week, and the stock just skyrocketed. It was up 50% in 10 days. Okay, and here's the thing. The amount of money that they're receiving only equated to about 1%. 1% of their market cap yet the market cap grew by almost 50% in a matter of just over a week. So the stock just looked like it was way, way out there to me. We bought it for $32 and change just over a year ago. We sold it for $90 and change on Tuesday of this week, and it finished the week at $79. So it came down from that level. I think it was a good move to go ahead and pull the trigger on that and take that profit because it was just so far extended. Now, I do like the company. If it comes back down to a price that I like, hey, we might go back into it again. But, when you go from $32.90 in a year and there's a reason that's not very fulfilling, then maybe you need to take the profits off the table. So guess what else we did? We trimmed AMD again. Yes, that's right. Again. Look, we just trimmed the stock like crazy. You know why? It's up 153% this quarter. That's why. 153% this quarter. The last round of AMD we bought in March of last year for 97. It's currently sitting at 514. We've trimmed it multiple times along the way. And you know what? We will just keep on trimming because that's what you do. You let your winners run. Okay, we're not selling the stock like we did with Global Foundries. But Global Foundries, I just felt it was way overextended. You want to let your winners run, but you got to take those profits because the market can turn. And when the market turns, this could be nasty, folks. I'm going to tell you, it'll only take a story from one of these AI companies, something along the lines of they only grew by 15% instead of 20% this quarter, or something along those lines, or the demand was just a slight bit off, still up, but off, and things could just turn on a dime. So we just keep on trimming back some of these things. So we did that. We also took some money out of the S&P 500 for you folks that are in the conservative models, right? The conservative models, we don't invest in individual stocks because they create too much volatility in your portfolio, but we do have exposure to the S&P, and we trimmed some of that back this week for the conservative models and the small models, and we added some cash management strategies to make some extra interest on some of the cash we've got in the portfolio. So look, we are just continuing to stick to our knitting here. There's a time to go all in, and it's not right now, okay? The time to go all in is when everyone is panicked. People are sick to their stomach. They want out of the market. They don't want to see the stock market ever again. They want to put all their money in CDs. They're terrified because things are crashing. That's when you go all in, all right? When things are getting frothy, frenzied, everybody wants to buy, everybody wants in, everybody wants more. That, folks, is the time to take your foot off the gas, and we'll continue to do so. Keep things spread out, keep things positioned. So if we get something out of left field or something unexpected, we're prepared. And I'll tell you something, I don't want to go too long because I'm rambling here quite a bit tonight. Let me just say this. Moving forward, the next couple of weeks, maybe the market stays constructive, but I think there's a big issue facing this market in the coming weeks, and that is a huge amount of IPOs coming to the market. Initial public offerings, right? You got SpaceX, you've got OpenAI, you've got these companies coming to the market with trillion or $1.5 to $2 trillion valuations. That's a lot of cash money needed to fund these IPOs. That money's got to come from somewhere. And many times you will see the market suffer when there's big IPOs that are coming to the market because folks take money from their other holdings to buy these other stocks. So we could see some weakness with that in coming weeks. So we'll just watch and see. But look, for right now, we love where we're positioned. We're doing great positioning for the year, great returns for the year. We'll just continue to take some of these profits off the table, tuck them away for a rainy day, and keep doing what we are doing. So with all that said, between now and next few meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it is buy that next Airbnb and rent it out and make some extra money. Maybe it is buy that boat. As look, it's boat season, folks. It's time to get out there on the water. You know what boat stands for, right? No, it's not bring on another 1,000. It's bring on another 10,000 now. Inflation, man, inflation. Hey, look, you know what your goals are. Don't just think about it. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.